If you are a senior, an immigrant, a green card holder, or someone who simply files taxes in the United States, a new IRS rule taking effect in 2026 could change how you file, for good. And this is not a minor tweak. This update could impact your tax return, your savings, and even your immigration status if you are not careful. Picture this. You file the same way you always have, like you've done for years, and then a letter shows up from the IRS saying you failed to report something you didn't even realize was required. Now imagine that one mistake leading to penalties, an audit, or delays in a citizenship case. That is exactly why this new rule matters. Beginning in 2026, the IRS is introducing new mandatory reporting items that particularly affect seniors over 60 and people who were not born U.S. citizens. Most people have no idea this is coming, and that is risky. But here's the good news. This video is not here to scare you. It is here to prepare you. If you understand what's changing and follow a few practical steps, you can avoid problems entirely. Over the next few minutes, I'm going to explain this in clear, simple language so you know what the rule is, who it affects, and what you can do now to stay protected. By the end, you'll know whether it applies to you and how to deal with it confidently. When the government changes something important, it can feel confusing and even a little intimidating. That's why I'm here. My goal is to walk you through this step by step in plain language. No legal jargon and no unnecessary panic. So take a breath, settle in, and let's go through what the IRS is changing and why it matters to you. Let's start with the most important question. What exactly is this new IRS rule? Starting with the 2026 tax year, meaning the returns you'll file in early 2027, the IRS is adding expanded, mandatory reporting questions to the standard Form 1040. This is part of a larger IRS push to increase financial transparency and improve compliance with foreign asset reporting rules. Put simply, the government wants more detailed information from certain taxpayers about money, assets, and income located outside the United States. Under the new rule, anyone age 60 or older and anyone not born a U.S. citizen will be required to answer extra questions right on the regular tax return about foreign bank accounts, foreign pensions, foreign Social Security type benefits, and international money transfers. These questions previously appeared mostly on specialized forms, or they applied only in narrower situations. But beginning in 2026, they become required for millions of filers. That means seniors, green card holders, naturalized citizens, and many visa holders will no longer be able to breeze past these sections or assume they don't matter. The IRS is also increasing data matching between agencies like USCIS and the Social Security Administration. That means what you report on your taxes will be compared more closely than ever with immigration and financial records. The IRS says the aim is to reduce unintentional noncompliance, meaning people breaking rules simply because they didn't understand them. But no matter the reason, once this goes into effect, the responsibility is on you to answer these questions correctly and completely. Even if you filed the same way for decades, your 2026 return will look different. Ignoring the change could create serious problems. That's why understanding it now, before it starts, is so important. A major part of this update involves new, lower reporting thresholds for foreign financial assets. In the past, many people didn't need extra forms because the limits were higher. Under the old rules, you generally filed Form 8938, Statement of Specified Foreign Financial Assets, only if your total foreign assets were more than $50,000 at year-end or more than $75,000 at any point during the year for single filers living in the United States. But the 2026 rule lowers those limits significantly for seniors and immigrant filers. Now, if you are over 60 or an immigrant filer of any age, the threshold drops to $25,000 at the end of the year, or $40,000 at any time during the year. That is a big change. It means many people who never reported foreign accounts before will suddenly be required to do it. And foreign assets does not only mean huge investment portfolios. It can include a simple checking account back home, an old retirement plan from years ago, a life insurance policy with cash value, or even partial ownership in family property overseas. In addition to Form 8938, there is also the FBAR, the Foreign Bank Account Report. The FBAR filing rule itself is not changing. You still must file an FBAR if the combined value of all foreign accounts exceeds $10,000 at any point during the year. What is changing is how aggressively the IRS will cross-check everything. Under the new system, your answers on Form 1040, your Form 8938 if required, and your FBAR records will be automatically compared. If you say you have foreign accounts on the return but fail to file the forms, or if numbers don't match, the system can generate notices and potentially trigger an audit. In other words, there will be far less room for mistakes, misunderstandings, or "I forgot." That's why even people with modest savings outside the US need to pay attention. You might be wondering, why are seniors and immigrants being singled out? The IRS has explained this directly. Based on their studies, these two groups create the largest share of unintentional errors involving foreign reporting. Seniors often have long, complicated financial histories. Some retired abroad and later returned. Others receive small pensions or government benefits from countries where they worked decades ago. Many simply don't realize the U.S. requires worldwide income reporting, even when the amounts are small or already taxed elsewhere. Immigrants face a similar issue. Millions of people move to America but keep bank accounts, property, or investments in their home countries. They may use those accounts to support family, pay bills back home, or save for emergencies. To them, those accounts feel unrelated to the U.S., but under U.S. tax law, they aren't. The IRS believes most of these people are not trying to hide anything. They just don't understand the rules. The problem is that, from the government's perspective, intentional or not, it is still non-compliance. So instead of expecting people to discover complicated forms on their own, the IRS is making the questions impossible to miss. By putting them on the main tax return and lowering thresholds, the government is effectively saying seniors and immigrants cannot claim they didn't know anymore. Even a small, inactive account you forgot could now require disclosure. That's why this is a big deal, and why so many will be affected starting in 2026. Before we go further, a quick pause. If this is helping you understand something you didn't know, like the video so more seniors and immigrants can find it. These changes are confusing, and the more people who see this, the fewer people end up with unnecessary problems later. Now let's talk about how this affects different groups, because the impact is not identical for everyone. If you're a senior who is a U.S. citizen by birth, you might assume this doesn't concern you. Not necessarily. Under the new requirements, any senior over 60 with financial ties outside the U.S. must answer the expanded questions. If you receive a foreign pension, keep a small overseas account, or still own property or investments abroad, you'll need to disclose that information more clearly than before. Even rarely used accounts you keep open for convenience while visiting family still count. The IRS is no longer treating foreign assets as a wealthy people only issue. For seniors, the assumption becomes, if foreign accounts exist, they must be reported correctly and in detail. For green card holders, the situation can be more sensitive. As a lawful permanent resident, you already follow the same tax rules as U.S. citizens, including worldwide income reporting. What makes this update especially important is the tax and immigration connection. When you apply for citizenship, USCIS reviews your tax history under the good moral character requirement. With increased data access, USCIS can see whether you answered the foreign account questions properly, whether you filed required items like FBARs or Form 8938, and whether anything is inconsistent. This doesn't mean a small mistake automatically destroys a case, but it does mean mismatches can cause delays, extra questions, and more scrutiny in an interview. In more serious situations, major tax noncompliance can contribute to denial. That's why green card holders especially need to be careful and organized once this rule takes effect. If you are a naturalized citizen, you might think that because you are fully American now, these rules won't apply to you in a special way. But the IRS specifically includes naturalized citizens in the expanded reporting group. The reasoning is simple. People not born in the US are statistically more likely to keep financial ties to other countries, even years after naturalization. So even though you're treated like any other American for tax purposes, you will still have to answer the new questions more completely. And if you are in the US on a work visa or another temporary status, this may still matter. If you meet US tax residency rules and file returns here, you can also be subject to the expanded reporting. For visa holders hoping to apply for a green card later, tax compliance is critical. Problems with IRS reporting can complicate renewals, adjustments of status, and other immigration benefits. In short, this rule goes far beyond retirees. It reaches almost anyone who has lived, worked, or built a life across more than one country. So the key question becomes, what should you do to protect yourself? Instead of stressing, take a few practical steps now. Step 1 is to gather complete information about any financial connections outside the US. Make a list of every foreign bank account, pension, investment account, cash value insurance policy, property interest, or business ownership you have. Even if it has little money, even if it's inactive, and even if you use it only when traveling, it still counts. Write down the institution name, country, account number if available, and the highest balance or value during the year. Many people get into trouble simply because they never organize this information. Doing it early can save huge stress later. Step 2 is to review your current FBAR situation. The FBAR rule exists today. It doesn't start in 2026. If your foreign accounts combined ever went above $10,000 at any point during the year, you must file an FBAR electronically with FinCEN. This applies even if each individual account is small. Many seniors and immigrants are shocked to learn this has been required for years. If you realize you should have filed in prior years but didn't, don't panic. The IRS has streamlined filing procedures that can help people come into compliance with reduced penalties when the mistake wasn't intentional. The worst choice is to ignore it and hope it disappears. Acting now, before the 2026 system increases enforcement, is one of the smartest moves you can make. Step 3 is to get ready for the new Form 8938 requirements. Because thresholds are dropping, many people who never filed it before will need to start. If you think your foreign assets might exceed $25,000 at year-end or $40,000 at any time during the year, start collecting statements and records. Form 8938 requires detailed asset-by-asset information, including values converted to US dollars. Waiting until tax season can make this hard, especially if you need foreign banks to provide older records. Proactive preparation makes the transition smoother. Step 4 is to ensure you're correctly reporting any foreign income. This is especially important for seniors receiving foreign pensions or foreign Social Security type payments. Many people assume that if money was taxed overseas, it doesn't need to be reported in the US. But in most cases, US law requires worldwide income reporting, including foreign pensions, annuities, rental income, and interest earned abroad. Tax treaties may reduce or eliminate double taxation, but the rules vary and can be complex. The new Form 1040 questions will ask more directly about these payments, so ignoring them won't be easy anymore. If you're unsure, a qualified tax professional with international experience can help. Step 5, especially for green card holders and anyone planning to apply for citizenship, is to keep organized tax records. Save copies of your tax returns, FBAR filings, Form 8938 if filed, and documents showing foreign account values. During naturalization, USCIS may ask for proof you complied with tax rules. Clean, organized paperwork can turn a stressful situation into a straightforward conversation. Many delays happen not because someone did something wrong, but because they can't easily prove they did things right. Record keeping is one of the simplest ways to protect yourself. To show how easily issues can happen, here's a real-world style example. Imagine a senior immigrant who has lived in the US for decades and always filed honestly. She keeps a small account in her home country with $15,000 in it, money she uses while visiting family. Because it's not a huge amount, she never connected it to her US taxes. She never filed an FBAR and never mentioned it on her return. Years later, during a citizenship application, an officer asks about foreign accounts. Suddenly, that small, innocent account becomes a major issue. Her case is delayed while she hires a tax professional to fix past filings and prove the mistake wasn't intentional. The process becomes stressful, expensive, and frightening. Under the new 2026 approach, situations like this are less likely to be missed. Mandatory questions force the issue earlier. In many ways, the system becomes stricter but also clearer. It reduces confusion and makes it harder for honest people to make costly, accidental mistakes. A few common questions are already coming up, so let's address them. Does this affect regular U.S. Social Security benefits? No. Nothing in the 2026 rule changes how standard U.S. Social Security is taxed. Those rules stay the same. The new focus is on foreign Social Security type benefits or pensions paid by other countries. If you receive retirement benefits from a foreign government, those payments are generally taxable in the U.S. unless a treaty says otherwise. The updated Form 1040 questions will ask more clearly about these payments, so you'll need to report them accurately rather than assume they don't matter. Do tax treaties still apply? Yes. Treaties can still reduce double taxation, but you typically must report the income correctly first in order to claim treaty benefits. The new rule does not cancel treaties. It makes it harder to skip foreign income reporting entirely. You also need to understand the potential penalties. The IRS treats foreign account reporting very seriously. If you fail to file an FBAR when required, a non-willful penalty can be up to $10,000 per account per year. If the IRS believes the failure was willful, penalties can be far higher, sometimes up to 50% of the account balance. For Form 8938, failure to file penalties start at $10,000 and can rise to $50,000 if the issue continues after IRS notice. Beyond money, there are practical consequences too. Foreign reporting failures can extend how long the IRS can audit returns, and for immigrants, can create complications with visas, green cards, or citizenship cases. Most people who get into trouble didn't mean to break rules. They just didn't know. The 2026 system is designed to remove that excuse by making the requirements harder to overlook. Before we wrap up, one more quick reminder. If this helped you, share it with a senior parent, grandparent, or immigrant friend who might be impacted. A share today could save someone a lot of stress later. As 2026 gets closer, keep the big picture in mind. The purpose of this IRS change isn't to punish honest people. The stated goal is a clearer system with more consistent reporting. For years, foreign reporting has been confusing, and requirements were buried in forms many taxpayers never saw. By moving key questions onto the main return, the IRS is making it harder to miss, and in a way, that can protect ordinary taxpayers. If you answer honestly and keep good records, you should have little to fear. And if you think you made mistakes in past years, options may exist to fix them before enforcement gets tougher. Acting early, getting organized, and getting professional guidance when needed are the best ways to stay safe. The most important takeaway is this: knowledge is your best protection. This change may sound intimidating, but once you understand it, compliance steps are manageable. Gather information, understand your filing obligations, keep records, and don't ignore foreign accounts just because they seem small. Small details are exactly what the IRS will pay more attention to going forward. If you prepare now instead of waiting until 2027, you can avoid most of the problems this change could create. Let's quickly recap. Starting with the 2026 tax year, the IRS is adding expanded mandatory questions to the regular tax return that will especially affect seniors over 60 and anyone not born a U.S. citizen. The questions focus on foreign bank accounts, foreign pensions, foreign Social Security type benefits, and other financial ties outside the U.S. Form 8938 thresholds are being lowered, meaning many more people will have to report foreign assets. The IRS will also cross-check information more aggressively between tax returns, FBAR filings, and immigration-related records, leaving less room for mistakes. For green card holders and citizenship applicants, accurate reporting becomes even more important because discrepancies can cause delays or extra scrutiny. None of this means honest taxpayers should panic. It means foreign financial reporting will no longer be something you can ignore. If you gather records early, understand your obligations, and get help when needed, you can handle this smoothly. If you want to stay updated on changes affecting seniors and immigrants, subscribe to US Policy Brief so you don't miss important updates like this. Tax and immigration rules can change fast, and staying informed is one of the best ways to protect yourself and your family. And as always, everything in this video is for general informational purposes only. It is not legal advice or tax advice. Every situation is different, and rules can depend on your country of origin, your income, and your financial history. If you have questions about your specific case, talk with a qualified tax professional or an immigration attorney who can review your circumstances. Policies can change, and you should always check official IRS and USCIS guidance before making major decisions. Thank you for spending this time with me and for taking steps to protect your financial and immigration future. I'm Michael, and I'm here to help you stay informed and prepared. Stay safe, stay organized, and I'll see you in the next video.